Chief Investment Officer here at Altair Advisors. I too want to welcome everyone to the event, both in person and online. It's great to see everybody back, and I'm excited to be back in front of the podium and not staring at the screen, so hopefully it'll be a little more fun. When we sit down and create the agenda for this annual fall forum, we always start with what are the topics, what are the themes that we want to cover, and then we populate the agenda and invite speakers. And this time it was pretty easy about the topics that we needed to cover, and that was inflation, interest rates, and the Federal Reserve. So you will hear those topics run through everybody's presentation. And you will hear it from different angles. I'm going to start with a market, asset allocation, portfolio management angle. Cara South is going to do it from the trenches of the municipal bond market. And then Professor Eichenbaum is going to do it from an economist perspective. So you're going to see different perspectives, but the same themes are going to run through the program. That's how we designed it. And maybe to put a finer point on why did we pick those themes, many of you know that we receive inflation data every month. And in the last 7 data points, we'll start with the statistic and then dive into the slides. Every day that the CPI has been released, the S&P 500, the stock market, has moved on average 3%. 3%, up or down. So it just gives, it's an understatement to say that what's moving markets right now is inflation, interest rates, and the Federal Reserve. That is clearly what's moving markets. So I'll dive right in, both here online and then virtually. You do have, as Anna may have mentioned, all the slides printed out in your folder. For many of you that follow our materials, you know that every quarter we come up with a cartoon. Whoops, sorry. Come up with a cartoon, and it encapsulates what we think is the main points of the quarter. We try to be funny, and sometimes we are successful and sometimes we're not, but hopefully we at least try to encapsulate what's going on. I can take no credit whatsoever for any of the cartoons. David Lynn and his team are the ones responsible for these great cartoons. So we start, I'm going to overview all 3 quarters, bring us up to date. We start with the first quarter, and this is really when the Fed started the interest rate increases. By the way, today is the 8th month anniversary of the first rate increase. Believe it or not, we've only been doing this for 8 months. It feels like 8 years, but we've only been raising rates for 8 months. And that first interest rate increase was only 0.25% or 25 basis points. So this is the Fed, Chair Jerome Powell. You'll notice he'll be the star of all 3 cartoons I'm about to show you. He's just starting this high wire act. How is he going to bring down inflation, but yet not kill the economy, not kill growth? It's going to be a tough high wire act, and Russia's invasion of Ukraine is not helping matters because that added to some of the supply crunch. We move to the second quarter. You notice the same star, Chair Jerome Powell. Now he's officially in rough waters. The second quarter, the S&P 500 was down over 16%. And he is clearly has his hands full. But it's the same tools. It's the Fed funds rate, and it's reducing the Fed's balance sheet. That brings us to where we are today. This is our most recent one, which we all just finished and released the last few weeks. And we're on this steep climb. Today, as we sit here, the Fed funds rate, which is the shortest rate that the Fed controls, is 3.75. And he's climbing. And of course, the debate today is how high is he going to climb? How high is he going to need to climb? And again, this is a topic you're going to see run through all the presentations. And it's a lot of debate as to how high he's going to need to climb. The market is telling us about 4.75, which is about 1% higher than he is today. Professor Eichenbaum is going to take us through a nice discussion about the probabilities that may have to go higher. Right now, the market thinks it's about 1% higher. Let's do a check-in on the markets. I don't think it's new news to anybody in the room or online that this has been an ugly year across the board. And I think that's one of the key takeaways is it's across the board. It's every single asset class. You start with S&P 500. All these are as of close of business on Friday, the 11th. so last Friday. S&P's down 15%. And then you go all the way down all the equity asset classes, stock asset classes, and again, you see double digit. The worst performing is the technology heavy growth sector. The best performing is the value sector. We're going to see in a second one of the reasons for that is because it has a high weighting to energy. Energy is one of the best performing sectors. In fact, it's the only decent performing sector. Now, coincidentally, but it's interesting, I'm not sure anybody would have guessed this, large cap, small cap, and international stocks, as of close on Friday, all were down 15%, almost exactly 15%. Now, the two bottom rows, which is the reason why we invited Kara South from Gannett to talk a little bit about the bond market, because as stock investors, we know we have to accept volatility. Unfortunately, that comes along with it. But bond investors usually don't like to see this level of volatility. And so the numbers you see at the bottom, taxable bond market down 14%, municipal bond market down 8%, these aren't just bad numbers, these are historic. Most people working in the bond markets today have never seen returns like this. And Kara and David Lynn are going to add a little perspective to this. As I mentioned, that was an asset class view. Now let's talk about the sectors. Again, the slide speaks for itself. There is really nowhere to hide except energy. It's the only sector that did well. Why did energy do well? Well, we had kind of this perfect storm of we reduced production, then Russia invaded Ukraine, and we had this supply crunch in the higher commodities, the higher energy prices goes right to the profits of some of the energy companies, which is why the energy sector from a profit and return perspective did very well. But pretty much across the board, every other sector is negative. So we see every asset class and virtually every sector is negative. Okay, so let's go to one of the elephants in the room, which is inflation. This is why all these asset classes and sectors are so negative. This is a chart of just the monthly CPI readings, and we have what we call both headline and core. Headline includes everything. Core, we strip out food and energy. And as we all know, that this spot over here is we're running at a 40-year high for inflation. Now, the quote good news, at least so far, is you can see that these lines have kind of headed down. And in fact, in this cycle so far, the peak inflation number was in June. We had a CPI reading of 9.1%. Peak inflation, 9.1%. I'm repeating it because that will be key to a few of the slides that I'm going to present and a few of the slides that Professor Eichenbaum is going to present. As I mentioned, the Fed funds, or the Federal Reserve, is in control of the federal funds rates, which is the short-term rate. What I did on the screen is I put what did the market think was going to be the high end of where the Federal Reserve was going to have to stop raising interest rates at the end of every quarter. So at the end of March, the first quarter, end of June, end of September. You kind of notice one thing, don't you? The market kept kind of getting it wrong. The market had to keep going higher with its projections. And so right now, this dark blue line is the most recent, what I'm calling now. And the market is predicting that the federal funds rate will have to go up to 4.75, so about 1% higher than it is today. Now you can kind of see, because we've been getting some better readings on CPI, the gap is at least starting to close. The gap is starting to close, but we had this huge gap up here between June and September, and of course, even between March and June. So the market is predicting about 4.75. How is all this interest rates and inflation impacted the bond market? And in particular, up here, I'm looking at the short-term 6-month Treasury. Well, this was yielding basically zero for 2 years and not much more than zero for the previous, basically the entire 6-year period here. And now you can see that we're up at about 4.5%. So the bond market, the short-term bond market, has reacted dramatically, and the yield on the short-term Treasury right now 6-month Treasury specifically is 4.5. And again, for the clients in the room, you know this is an area that we like, and this is an area that we're moving client portfolios where it's appropriate, where there's bond exposure, a piece of it into this 6-month Treasury, because we find that yield to be very attractive at the 4.5 level. I said that inflation is running at 40-year highs, but we peaked out on the June number at 9.1%. So what I did here is I took the most recent reading, and that's the one we received last week. And if you remember when we received it last week, the S&P 500 was up 5.5% that day, one day, probably a little on the high side, even if inflation did peak. And what we did is we took the October numbers and the April numbers and the October numbers, and just to show you how some of the largest components, CPI has 19 components, I'm showing you the top 10 by weighting. And the message is that although inflation is coming down, and although we've peaked, we have a whole group of categories that are improving or in the green, and then we still have categories that are continuing to, their increase is actually growing. They're growing more. But overall, we do see inflation moderating. One of the other key themes that's going to run through today is this idea of goods versus services. And I think this is going to be a really important part of the discussion. Professor Eichenbaum has a great discussion. He's going to take us through about, well, how did we get here? And a lot of it is we're coming off some crazy levels created by the pandemic. And so right now we're seeing the goods part of the economy, energy, cars, furnishings and supplies when we were all sitting at home ordering furniture. We're starting to see this come back to earth. We're starting to see these things come back down. That's important for inflation. Food hasn't quite got there yet, even though that's certainly a good. All the other categories are services, where we're seeing inflation continue to accelerate. Another look at some data that's moderating. Why is goods coming down from an inflation perspective? This is the new orders on the manufacturing. This is the one I picked, but there's a few that we could have shown. And the first thing you know, the higher the number is the greater the new orders, the higher the new orders, and then the lower the number is the fewer. What you can see is during the pandemic is these readings were almost in crazy territory, and I mean crazy on a good side. The orders were way higher than normal, and now we're finally seeing them get back. So typically when we show charts and we say an index is contracting, that's a bad thing. But nowadays when things are coming back to earth, it can actually be somewhat of a good thing because we're moderating inflation. And why do we want to moderate inflation? So the Fed doesn't have to keep raising rates and push us into a bad recession. And so bad is kind of good right now when it comes to some of this moderation. Again, on the housing side, we can see that taking place where I think everyone knows the housing market is certainly slowing. 2 years ago, between today, we're selling about 2 million less homes a month, existing home sales. That's our bar chart here. And one of the reasons is not only is the bond market, not only is the short-term side of the bond market reacted, but the 30-year mortgage has reacted. We're running just shy of 15-year highs on the 30-year mortgage. So it's a moderating economy. There's no question about that. And that moderating economy is also moderating inflation. And that was by the design of the Fed. They wanted this to happen. So part of this is actually happening. Another take is a more broad look at the future of the economy. This is the leading economic index, LEI. Again, chart is pretty simple. It's showing that we have a moderating economy, a slowing economy. And the real question here is, can we slow the economy so that we moderate inflation but don't hit a more severe downturn? Again, it's our view that we don't hit a severe downturn. Slowdown, absolutely, that's already in the data, but severe is what we want to avoid. Some of the other economic indicators, though, are still pretty positive. If you take a look at the, just this is a spattering, and in fact, this is the grouping or one of the groupings that the NBER, which is the group that stamps things recessions, look at. So you got everything from GDP to income. Real retail sales, you notice, is the only negative in this chart. That's primarily because finished goods, manufacturing, new orders, is coming down. Now, we actually just got a number this morning, so this bar is actually not quite this negative anymore on the 6-month change. But what you can see is an economy that still has some strength to it, but it is slowing, it is moderating. Okay, so my next 2 slides are by far my favorite. So we're gonna move into what I call the, okay, so what? What does this all mean for my portfolio, for markets, etc.? Many of you may have seen a version of this before, but we thought it was important enough to reiterate it. What we did is we broke all the post-World War II recessions into 2 categories. Now, we could have used different definitions, we could have broken it into more categories, but we just did a simple break between 2, and we called it mild, and we called it severe. And I also think, as an aside, that's probably a lot of what's going on right now when we're reading things is we kind of have these definitional nomenclature issues. I feel like it's kind of ordering hot sauce. Is it mild? Is it medium? Is it hot? Is it on fire? So it kind of is, we're using different words to say the same thing. But in our world, it's mild versus severe. The punchline is, if you look at this downturn, the S&P bottomed out so far on October 12th, about 25% down for the year. And if you look at the average of all the mild, and we're defining mild by GDP and corporate earnings decline, we're about there. The damage is pretty much more or less done. Can be a little more, a little less, but it's about there. If you believe, which right now we do, you're going to avoid a severe recession. You don't get to these more dramatic levels in the S&P corporate earnings or GDP. So right now we don't believe it's going to be a severe recession. Could it be a mild recession? Yeah, we're not going to get too overly concerned whether it's stamped a recession in 22 or 23, because a lot of the damage has already been done, at least in our view. Now let's take a look at it from an inflation perspective, perhaps the most germane slide of the current situation, which is, when does the market recover after you've hit a period of inflation? And the punchline here, or the spoiler, if you will, is that the market does not wait for inflation to come down before it starts its recovery. And we're looking at these other high inflation periods. Some of them, you can look at March 80 in particular, took years for inflation to come back down to, quote, normal. And then we took a look at the peak, and we looked at the trough. And what you can see is, if you bought the S&P at the peak, so inflation had not yet come down, but it was actually at the peak, your forward returns are very, very good, 1 year and 2 years. But if you actually wait for inflation to go all the way down, the forward returns are, at least on the 1 year average, or flat basically, and then the 2 years kind of average S&P longer term returns. Again, the punchline is, as we all know, the market is forward looking, and it's going to front run the economy both on the downside and on the upside. So the recovery, if that June number, that 9.1% inflation number, was in fact the peak, we're over here now. We're over here now in waiting for, it's not going to be linear, there'll be a lot of volatility, but the market will not wait for inflation to go back down to the trough before it starts its recovery. Everyone likes to ask us, well, how does the market do after midterms? We just had a midterm election last week. We don't necessarily have the exact results, but we know directionally the Senate's going to go to the Democrats, and it looks like the Republicans will take the House. And it turns out that actually doesn't really matter much from a stock market perspective. We look at every single midterm election from 1950, and you look at 12 months forward, the S&P has been positive. So more of an interesting fun fact than it is market driven, but at least that's what we see right now. My last slide before I do a recap and hand it over to David and Kara is really a setup for their section. Kind of goes back to my comment of that the bond market this year has been historic. These are the annual returns of the taxable bond market. Now, Kara is an expert in munis, but I wanted to use this because it went back a little further. And so the 1976 is the first year that this index started. And what you notice is we've had pretty steady returns. We had 4 of these blips where markets were down. But what do you notice about 2022? You can add up all the losses, those 4 losses, you can multiply them by 2, and you still don't get what you got this year. So this has been historic on the downside for bonds. Let me go through my recap, and then I'll invite David and Kara to the stage. As I mentioned, virtually all asset classes have performed poorly this year. Energy sector is the only positive. Although inflation peaked in June and is now moderating, it's still running at 40-year levels, 40-year high levels. Federal Reserve will keep raising interest rates until they moderate inflation. Right now, the market is predicting another 1% higher over the next few meetings, getting it up to 4.75. The U.S. economy is a mixed picture. We still have some very strong indexes and indices, but there's no question it's slowing, it's moderating. And then finally, probably the most important, I think the midterm election, 12 months forward is more fun than anything, but I think the more significant data as it relates to right now is this inflation, which is that the market does not wait for inflation to go down before it starts a recovery. So with that, I'm going to invite David and Kara to the stage to talk about the bond market, and then I'll return and then we'll open it up for questions on both sessions.
Thanks, Jason. Well, as Jason mentioned, my name is David Lin. I'm part of the research team at Altair, and I just wanted to welcome all of you and say it's great to be here live with all of you in person. You know, typically, when the equity markets are down 15% or so, that's probably all we would be talking about, right? Bonds would probably be doing fairly well. But unfortunately, our steady Eddie bonds are also down about 15%, as Jason mentioned, and that's really unprecedented. It's the worst year on record. And so, given all the chaos that we're seeing in the bond markets this year, it really only made sense to have one of our recommended bond managers to be with us today, and that is Gannett Welch & Collar. GW&K is a Boston-based firm that manages around $45 billion in assets. They've been helping us manage muni bond portfolios for more than 25 years. And today we have Kara South with us. She's a principal at GW&K. She has more than 16 years of industry experience. She's a portfolio manager across all of their municipal bond strategies. And she's going to help us kind of dissect what's been going on in 2022. So Kara, welcome, and let's jump right into it.
Yeah, thank you for having me.
So Kara, maybe we can start with, let's talk about 2022, which is such a unique year. Maybe to get everyone on the same page, maybe you can frame what has happened in the bond market this year, not only on munis, but also on the taxable side, and then we'll kind of go from there.
Of course. So it's been an extremely challenging year for all fixed income markets. In fact, it's been the worst bond market that we've had in over 40 years. And it's been a rate-driven sell-off just due to the high inflation and aggressive Fed policy that we've seen. So really, no matter where you've been invested in fixed income, and this is looking at the broad indices, you're looking at negative double-digit type of total returns. So you have the U.S. Muni Index down 11% year-to-date, you have the U.S. Treasury Index down 13%, and you have U.S. investment-grade corporate bonds down 17% year-to-date. And really, the longer your duration or the more sensitive you were to interest rates, the worse your performance. And I think a good example of this is if you look at the 30-year Treasury, which is AAA rated and has no credit risk, is down 35% year to date. So it's really been a tough year across the board. And what's made this year different than prior years, in addition to the rapid rise that we've seen in rates, so you have treasury yields up 200 to 350 basis points across the curve in a 10-month period, but really the larger factor has just been the low rate environment that we started at. So you figure we ended the end of last year with a 10-year treasury yield of 1.5%. So when you think about the return on a bond, you have two components of return. You have your coupon, which is fixed and is set at the time of issuance, and then you have your price return, which is going to fluctuate based on changes in interest rate, but you ultimately get par at maturity. So what's happened this year is because we started out with such low rates, it wasn't enough to offset that negative performance. So there's been periods in the past, if you go back to 1980, back to 1994, where we've seen similar types of increases in yields, but at that point, the starting yield was so much higher, it was able to offset it. So I think 1980 is a good example of that. So in 1980, the 10-year treasury yield was at 10%. So even though you had negative price impact with the rising yields, it actually, you had a positive return for the treasury market overall.
Okay, so it depended it's not just that the rates went up, it depended on the pace that rates went up,
yeah,
and it also depended on the starting point where yields were at the time.
Exactly.
Okay, so given that inflation and interest rates are driving this market, especially in 2022, can you talk a little bit about how GW&K views inflation moving forward, as well as any thoughts on the Fed and their interest rate policy moving forward?
Sure. So I think it's helpful to back up a little bit and just look at what the market was expecting at the beginning of the year, which was for 3 Fed hikes for all of 2022, or 75 basis points. And then you look at where we stand today with the upper bound on Fed's funds at 4%, and the market expecting another 100 basis points by the spring of next year before we start to see cuts in 2023, 2024. The Fed has been very clear that their number one priority is making sure that they get inflation under control and back towards that 2% target. So as Jason mentioned, the data that we've had recently has been supportive of that. So you have the month-over-month core CPI at 0.3%. So if you look at that over, kind of annualize it, you're looking at 3.6. So it's definitely directionally headed correct. But again, to what Jason mentioned, if you look at the components of CPI, you've had goods inflation come down a lot, but you still have services inflation that's remained high. And that's more closely tied to wages, so it could be a little bit harder to tame. I think the market this summer got a little ahead of itself in expecting the Fed to pivot. And from my perspective, I still view that to be one of the biggest risks is, the market sees some of this more favorable data and starts to expect the Fed to reverse course. And it's important to keep in mind that a slowdown from the Fed is not a pivot. In our strategies, we don't look to forecast interest rates or predict the direction of interest rates. We look to take advantage of what we're seeing in the market based on changes. So we look at the absolute level of yields. We look at the slope of the curve. But in our perspective, it can be very difficult to get that correct all the time. And I think this year has been a good example of that, just based on how much market expectations have changed. Maybe one other point I would just make is even if the Fed does continue to hike rates, the front end of the yield curve, where you think of a 2-year treasury, is going to be very sensitive to what the Fed's doing. But if you go further out the curve, say in a 10-year maturity, that's going to be much more sensitive to expectations around growth and inflation. And so if the Fed is more aggressive in hiking front-end rates, you could actually see long-term rates come down more. So just something to think about.
Great. Thanks for providing all that color. Let's talk a little bit more specifically about munis, since that's really your expertise. Can you elaborate a little bit more on what's been going on in the muni bond space? And what is really interesting to a lot of people is how much better it held up than U.S. Treasuries and investment-grade corporates and so forth. So maybe you can talk a little bit about why that was.
Yeah, a couple of factors I would highlight. One is just the tax exemption. So if you look at muni yields relative to treasury yields, that ratio is typically about 80%, meaning that a muni yield is going to be about 80% of the treasury of the yield of the treasury. So when you have treasury yields, say, go up 100 basis points, you're only going to have muni yields go up 80 basis points. And so therefore, you typically have municipals outperform into a rising rate environment. The other factor that's been supportive of our market this year is just supply. So supply is down year to date, and more recently it's been extreme. So in September and in October are typically pretty heavy months for us from a supply perspective, but this year we've been down 40% on a year-over-year basis. So you just have more demand chasing fewer bonds, which leads to tighter yields. And we have seen a lot of outflows, mutual fund outflows within the muni market this year, but I would say that demand still remains very strong. And the place that we see that is in the new issue market. So if you look at deals that are pricing, we see them multiple times oversubscribed, meaning more demand for bonds than they're going to be issuing, and that leads to better pricing for issuers.
Got it. So we've kind of all seen this around in the economy, but clearly growth is slowing. It's possible that we have a mild recession looming. A lot of investors are a little bit worried about how state and local governments are going to hold up if in fact we do enter a recession in the next 18 months, 2 years. What would you say to those investors?
Yeah, so from a fundamental perspective, munis remain very healthy, and that's partially been driven by the strong revenue growth that we've seen and the record level of reserves that have been built. What I would add to that, and I think is different now versus say a 2008, 2009 type of time frame, is just the federal support and stimulus that was received during the pandemic. And that has really allowed municipalities to shore up their balance sheet, to contribute to rainy day funds, to make additional pension contributions. So fundamentals are in a really good spot within the muni market. One thing that we track is just the upgrade downgrade ratio. So that's looking at changes in credit rating. So if the rating agency lifts the rating, then you're getting an upgrade, and the reverse for a downgrade. And if you look at the ratio through the first half of 2022, it was 16-1, meaning 16 upgrades for every 1 downgrade. And that just gives you an idea of the trajectory that we've seen. And you can include the state of Illinois and the city of Chicago in that upgrade camp. So Chicago was actually upgraded last week from high yield to investment grade. So there's been a lot of that, and that's just reflecting the overall direction that we're seeing. The other thing that I would mention with municipals, it's a very high quality asset class. So we're a high quality manager within a high quality asset class, but in general it is a very high quality area of the market. One way that you can look at that is if you look at historical default ratios. So if you go back over the last 15 years, the default ratio for munis is close to 0. If you compare that to the corporate market, it's around 2%, which is still a very low default rate over a 15-year period. But probably what's more interesting is if you look back to the 2009 time period when corporate defaults were around 6%, munis were still close to 0. So it's just it's a high quality part of the market.
Great. So Cara, most of the people in this audience have GW&K muni portfolios. What would you tell them about how you're positioning your portfolios today, and where are you seeing some of the biggest opportunities?
Yeah, so we are always looking to capture higher yield within our client portfolios. So what that has meant this year is we've been looking to sell some of the shorter duration bonds within the portfolio that have held in relatively well and are what we view to be more expensive. And we've been buying bonds further out the curve that we view to be relatively cheap and picking up incremental yield. So on those buys versus the sales, we're picking up 80 to 100 basis points of yield. So this year, we've really seen investors pile into the front end. So sort of 5 years in as people have been concerned about rising rates. And what that led to in the muni market was really tight muni treasury ratios. So that's our best indicator of relative value. So this summer that got as tight as 55%, which actually doesn't make any sense, but that's where people were really buying. So we're always looking to sell into that. So we were selling those bonds into those really tight valuations and buying those bonds further out the curve. So that's what we have been doing so far this year. As far as like sectors or more on like the issuer side of things, I would just mention on the supply side, we've seen a lot of issuance from states like New York and Texas. So we'll look to take advantage of that when they flood the market with supply, and we're able to pick up some incremental yield for the higher credit quality.
Got it. So when we talk to a lot of our clients and just read a lot of the research that is out there, we know and hear that bond investors are generally frustrated with the returns because of what has happened in 2022. It's really taken away a lot of the total return that we've seen over the last several years. So I mean, if you look at like 5-year total returns on an annualized basis, it's pretty much flat. If you look even 10 years out on an annualized basis, bond returns are maybe 1% on an annualized basis. And so what would you say to a bond investor about sticking through it and why they should continue to hold bonds in their portfolios?
So I would say as a long-term investor, you actually want interest rates to increase. And the reason for that being is you're able to take that coupon or that income that you're receiving and invest it at higher and higher yields. And what that means over time is that your effective rate of return will actually be higher. So the biggest component of bond return is actually that reinvestment rate. The other thing I would highlight that's different between bonds versus stocks is that unless there's credit impairment or you have a default, you're always going to get par at maturity. So the price path that the bond takes between the time that you buy it and the time of maturity is irrelevant, since you know that that is what you're going to get. So a stock price might stay depressed indefinitely, where you know a bond is always going to go back to par. The other thing I would add is from a yield perspective, when you purchase a bond, you lock in that yield at the time that you buy it. So periods in which you see negative performance are going to be offset in the future by positive performance until the yield converges to the yield that you locked in when you bought it. So the key to all of it is to make sure that you stay invested so that you're able to have that recovery back to par. And so I think just keeping that in mind, we view this to be a really attractive entry point into the muni market. Yields are higher than we've seen in over a decade. So you have to go back to 2009 to capture these type of yields. So we think this is a good entry point. Maybe just one way to look at it too is if you look at munis, say, versus other taxable alternatives, what we use to compare is we look at the tax equivalent yield. So for an investor in the highest tax bracket, even though, say, the yield to worst around for a AA muni right now is around 3.5%, if you adjust that to compare it to other taxable alternatives, it's actually closer to 6% because you have that tax benefit. And so for a high quality asset class, we view that to be a really attractive yield. It's comparable to asset classes with lower credit quality.
Great. So it's a good time to be a bond investor, right?
Yes.
Okay, great. I just actually realized that we're pretty much out of time, and I wanted to save enough time for people in the audience and those that are online to ask questions as well. So we're going to be passing around some of the microphones there. I'll also ask Jason Laurie to come back up to join us in the event that any of you have any questions for him or myself. So feel free to ask any questions. We have a question up here. Do we have a microphone, Anna, for? Okay, and I will repeat the question for those that are online.
Yes, the question I have, a lot of projects seem to make it through the midterm elections where a lot of projects across different states were approved, and it's quite an initial amount of supply potentially. How long does it typically take to see that come to market? When what's the time span typically look like? In kind of a generic form. I'm sure it varies by state, but what would be your historical point of view?
Yeah, so the question was related to a lot of the bond issuance that was approved during the midterms. And that we've seen, like New York passed a really big climate project. So that's going to be about $4 billion or so that they'll be bringing to market. You saw a lot of issuance that's expected from school districts. But I would anticipate it to take a while to actually come to market, so probably like the end of next year or so. But in aggregate, it is a pretty big number. So it was about 60 billion or so that's been approved. So it'll be interesting to see exactly when it comes, but I would expect it to be a little while.
Anna's funneling all the online questions, so we'll go back and forth.
You can repeat it after I ask so that people online can hear, but it's given that munis are mostly owned by retail investors, won't massive outflows continue if the economy weakens?
Cara?
Can you repeat the question, Jason?
Sure. Or yeah, so the question was related, will outflows continue just given that the muni market is a retail dominated market?
Because I think it's been over 100 billion so far in 2022, right?
Yeah, we've had a record amount of outflows within the muni market, given that it is retail dominated. So it actually reversed all the inflows that we saw last year. So we had 100 billion of inflows last year when rates were near all-time lows. And we've had outflows into a rising rate environment, which is actually the opposite of what you would want to do. So as far as, you know, people getting back into the market, I don't know exactly when they will want to do that, but from a performance perspective, you actually want to get invested in the market. Typically, performance will turn before fund flows do. So you'll continue to see muni investors exit the market, but performance will be getting better. I would say that retail investors do tend to be very sensitive to negative performance, and it's actually the worst decision you could make, but people don't like to see negative returns.
Mike, did you have a question?
Yeah, I think people understand if you hold a bond to maturity, you're going to get your money back. But then people see in their portfolios the manager selling those bonds and realizing the loss. Can you give an example of why you would do that in an environment where just simply holding would return your money?
Yeah, so
Can we repeat the question?
sure. The question was related to, you know, you get par if you hold it to maturity, but you'll see managers sell a bond that's at a loss prior to maturity, which we do in our portfolios if we're able to find a more attractive alternative in the market. So you figure the loss that's embedded in that bond, you're not losing if you sell it and buy something that's underperformed more. So you're kind of like capturing both. So that's why we're always looking to sell bonds that are relatively rich and buy bonds that are relatively cheap. So if you buy a bond that has a 5% say yield, or you sell a bond that has a 5% yield and you buy a bond that has a 5.4% yield that's underperformed more, you're capturing that loss plus the higher yield. So you're capturing the loss and then you purchase as well. And you're capturing the higher yield.
Other questions in the off or online, Anna? Any?
Given your views, what changes have you been making in portfolios?
Okay, yeah, so the question from online was, given our views, what changes have we made in the portfolio? Really, the portfolio changes that we're making right now are, I mentioned on one of the slides about the 6-month treasury being attractive at that 4.5% level. Cara talked about the front end of the curve being the most impacted by the Federal Reserve. And so for a portion of our taxable bond exposure, not the munis, but on the taxable side, we're moving, have moved and continue to move those into short-term 6-month treasury. So we are just in the process of doing that as we speak.
About roll, which we look to capture in our portfolios. So what roll reflects, it's a natural appreciation of a bond as it rolls down the yield curve. So thinking of a 9-year maturity bond going to an 8-year maturity bond, you're going to naturally have a yield decline, and that leads, when you have yields down, price up, and that results in a natural appreciation of the bond. So we'll look to capture that in our portfolios. which you can only do it as an active manager, and that contributes to our expected return. So if being your return, assuming no changes in interest rates, you would add that role to look at what your expected return would be over a 1-year time period. So for example, if the yield was 3.5 and you had roll of 30 basis points, you would have a 3.8% expected return as we capture that natural appreciation of the bond as it declines down the yield curve. Yeah, so for our intermediate strategy.
Can you repeat the question?
Oh, sure. What is the yields on our strategy, which right now is close to 3.5%. So I actually used the actual yield as it currently is, and the current roll is expected to be around 30 basis points. And again, another way to think about it with munis is to do that tax equivalent yield, so adjust it for the tax rate. So again, that's going to get you over 6% if you adjust it for the highest tax bracket, excluding the state tax rate.
I know you're all anxious to hear our keynote speaker. So we'll even put up the next slide and we'll talk about I'm always very hesitant to interrupt good conversations, but I do want to be mindful of keeping us on schedule. So welcome back, everybody. Hope you enjoyed your little lunch there. I'm Steve Weinstein, Altair's chairman, and it's my distinct pleasure to introduce our keynote speaker, Dr. Martin Eichenbaum. Now, every year in preparing for this program, Anna Nichols, Jason Laurie, David Lynn, we all get together and we say, well, how can we find a keynote speaker who has the expertise, areas of focus, and perspective given our current economic situation? So we look for someone who's an excellent presenter and can translate economic data in a manner that can be both meaningful and useful. And it's a tough combination, so you think, well, let's get a college economics professor. That sounds like a good idea. And Martin Eichenbaum has both of those qualities. So Dr. Eichenbaum is the Charles Moscos Professor of Economics and co-director of the Center for International Economics at Northwestern, where he has taught since 1988. His research focuses on macroeconomics, international economics, and monetary theory and policy. Now, during his career, he's also taught at Carnegie Mellon, that other great university down in Hyde Park, and the University of Pennsylvania. In addition, he's been a consultant to Federal Reserve Banks of Chicago, Atlanta, and San Francisco, as well as the International Monetary Fund. Now, in your little icon there that you can put your phone on, you can see all of his accolades. But the one I thought was very interesting was that he's a research associate at the National Bureau of Economic Research. That's the body that determines exactly when we're in and out of a recession, among other things. And currently, Marty serves as the co-editor of the NBER Macro Annual. He received his Bachelor in Economics from McGill University in Canada in 1976 and a PhD in Economics from the University of Minnesota in 1981. Please help me welcome Professor Martin Eichenbaum.
Thank you very much for that gracious introduction. I have learned over time that being an economist, you're sort of a negative beta asset. You're counter-cyclical. People want you to speak when times are bad. So 2008 was a great year for speaking. 2020 was great, and this is a great year for speaking. Not sure that's good news for anybody else, but anyways. So what I thought I would talk about today was background. How did we get into the situation that we're in now? So that's the COVID recession and the recovery. Then I want to talk about what's causing inflation, because that's really central to thinking about how the heck we're going to get out of this situation. I want to talk about the Fed's bet on a soft landing. So to be clear, what I mean by a soft landing is what other people have talked about. Well, there's going to be a recession, but it's not going to be too bad. So that's just a nice way of saying it won't be too bad. And I will be a little bit skeptical or talk about some things that could go wrong in this soft landing scenario. And then I want to end with flashpoints, by which I just mean things that keep me up at night, that are not necessarily very high probability, but should make you a little bit nervous too. Okay, so we can think about the initial impact of the pandemic. World real GDP growth in 2020 was, a catastrophe, minus 3.6%. And you can see red means worse, green means good. So we're ESG friendly here. And it was really bad in most of the world. China initially was, doing relatively well. And one thing, if you've studied COVID, which I've tried to work on, is no one country did it perfectly. And at different stages of COVID, different systems had different advantages and disadvantages. So we may have screwed up a little bit then. China is kind of screwing up a little bit now. So take your turn. Now, the percent change in real GDP for the US was, I emphasize, unprecedented. There's just nothing in the books like it, right? Certainly for the post-war decline and subsequent recovery. So you see these absolutely wild declines, very rapid and a pretty quick rebound, not so coincidentally associated with vaccines. Now, at the same time that the impact of COVID was unprecedented, the US policy response was also unprecedented. Maybe we were fighting the last war, namely 2008. It's easy to think after the fact and say, oh, gee, they did too much, but try and put yourself in your head in March of 2020. So the stimulus bill approved by Congress beginning in 2020 really released the largest amount of federal money into the US economy in recorded history. There's nothing like it. So we're talking about $5 trillion, right, just on the fiscal side. And it went to, households, mom and pop shops, restaurants, airlines, government, schools, other institutions. One of the reasons that the states and munis got through all of this, right, was that the government was really helping when tax revenues were really falling. Right? Well, that's partly because of Washington's response. More germane, perhaps, for today, there was literally massive Fed intervention to support the economy and financial markets. So just a quick summary of things that you know. The federal funds rate went down to zero. Right? We'll come back to that federal funds rate, but it was just down at zero. There was quantitative easing. What's that? Just massive purchases of debt securities by the Fed, primarily Treasury, mortgage-backed securities, in an effort to support those markets. There was lending to securities firms, namely low interest rate loans to the primary dealers. They backstopped money market mutual funds, that is to say they lent to banks against collateral that they purchased from prime money market mutual funds. Repo operations, which are huge. The Fed vastly expanded the scope of its repurchase operations, basically to funnel cash into money markets. There was direct lending to major corporate employers, buying new bonds, providing loans. The Fed purchased existing corporate bonds. The Fed bought commercial paper, essentially lending money directly to corporations for up to 3 months. They made loans to small and mid-sized business. And they supported households, consumers, small businesses. I mean, you name it, they did it. Student loans, auto loans, credit card loans, loans guaranteed by the Small Business Administration, on and on and on. So this is not exactly a Milton Friedman paradise, for good or for bad. You just had massive intervention. Now, what happened to the size of the Fed's balance sheet? And this is really quite a startling slide when you see it. So in 2008, we started the old world, the Ancien regime, at an $800 billion Fed balance sheet, the assets that they had. And then after the financial crisis, you're at about $2 trillion. And then you get to here, we're at 4 trillion, and then it zooms up to $9 trillion. That's the stuff that the Fed owns, okay? And you might say, how would you pay for something like that? Congress didn't pass any bills, right? We didn't vote in any referendum. Well, it turns out this is the magic of the Fed, is they printed money, essentially, and created bank reserves. Whoever's the chairman, person or woman or man, just hits a tab button, and all of a sudden, I got enough money to pay for that stuff. That's just how it happens. And so if you look here at the monetary base, but we could look at many, many different aggregates. What's the monetary base? It's just currency in circulation and commercial bank deposits held in the central bank reserves. Well, that just went up from, it went from, 3 trillion to a peak of over 5 trillion. That's one example of how the Fed just hit the tab button, the enter button, and all of a sudden, you can't fight the Fed on that dimension. They can hit that button as many times as they want. Okay, so that's the Fed on the one hand. So they're pumping a lot of money into the economy. What about the government deficit? So this is Washington now as opposed to, the Treasury. Well, the primary deficit, that's just excluding interest payments of the federal government, exploded to 15% of GDP in 2020 and 12.4% in 2021. How does the government finance those deficits? Well, the Fed bought most of the Treasury securities. So basically, the Fed's printing money through the intermediary of a thing called the Treasury security in order for the government to run its operation in this emergency situation. Okay? So the Fed is printing money in order to send out all these checks and all the forms of help that was being provided to the country. And this is a very dramatic graph. It's a little bit crowded, but what I have up here is the primary deficit and net interest rate outlay. So you can see here this unprecedented deficit, so it's about 15% of GDP. There is one other time when it was even bigger, and that was World War II. Right? When we were fighting the bad guys, we did it by burdening future generations because they were also going to benefit from the victory. By the way, do you know how we paid this off eventually? Well, let's look at the debt. Here was the national debt as a percent of GDP. Here's where we are now. So it's pretty close to what it was at the end of World War II. What's this insane thing? Well, that's the Congressional Budget Office's estimate of what will be the national debt if we don't do anything different. There is no way in heck that we're ever going to get to that number because it will be the end of the world before that. So this is just saying something has to change. And we could spend a lot of time talking about what that is. That's not really the key point today. How did we get out of World War II? Well, a combination of tax increases and a bunch of inflation. We inflated the real value, a lot of that debt away. Okay? So that's just important from the perspective of history to remember that. So where are we now? And this recaps a little bit of previous comments. Well, this is employment. It's pretty dramatic if you look at it, right? So you can see this is going back to, here's the financial crisis. Here's employment. You get this huge drop, but we're now actually above pre-pandemic employment levels moderately. Okay? So that's good. Here's net worth and disposable income. And this is a pretty crowded graph, but just it cuts to the point of whether we're going to have, financial crisis or anything like that. What you want to see here is the red is real disposable income. What are these big spikes? Well, that's the government sending checks out, right? That's stuff arriving via the mail. That's disposable income. So you can see these big peaks, and then the checks stop coming, and you sort of come back to kind of where we were before the pandemic. And here's net worth, and that's very relevant for this crowd. Net worth, of course, went down, but it's now up. There's a slight downward tick because of the horrible nature of equity markets and bond markets, but it's important to keep that in perspective that the net worth of households and nonprofit organizations is still very, very high by any standard. And this is also very important. And when you work for a bank or you work for the Fed, one of the things that you look at is there's this thing called a stock of excess household savings. Households have saved much more over the past couple of years than you would have anticipated, right? So they're sitting on a lot of savings. Part of that was people got their checks. There wasn't much to spend them on during the pandemic, and they sat on them. They were slipped out and worried, and they sat on them. What's true is that excess saving is primarily less affluent people. That excess saving has gone away. Okay, so it's basically people, relatively affluent people. The other thing is household debt service payments as a percentage of disposable personal income it's gone up, but it's still very low by any historical standards. And so that's really important in thinking about, say, comparing this to previous crises. Will we see a crisis? No. The balance sheets, certainly of households, the balance sheets of certainly rich households are in pretty good shape. Okay, and so that's important as background in thinking about how big a recession could we be facing. And here's something you've already seen, and that is what is happening to household spending, real consumption expenditures. You've got services, total goods, durables. You know, we had a big increase in durable goods expenditures, right, that went up, and now it's coming back down. Services are going up. But that's, you know, that is partly going to come back to the issue of inflation. But all in all, it's a picture of an economy recovering, of people in pretty good shape. But labor markets are very, very tight. So what's this graph? This is something that the Fed looks at very carefully. The unemployment rate is the blue, and you can see that's a very tight labor market by any stretch of the imagination. You can also see unfilled job vacancies, and that's the red. And that's all of you when you work in your business and you say, look, we have great jobs, we can't fill them, right? That's you over there, you know, tearing your hair out when you're trying to fill out those jobs. But notice it's a slight downtick, right? So the economy is starting to cool off, but remember, it's from extraordinary tight levels. Now, this is really important. You all know that there's upward pressure on wages, right? So here I have wages and salaries and benefits of civilian workers, 12-month percent change. You've got wages and salaries and benefits. And what you want to see here is they've gone up. All of you know that, right? You're paying a lot in wages and you're not happy about it. And it's basically going up by, you know, depending on how you count, 5 or 6%. And that's a problem. But it's actually worse than that. If you look at employment costs, taking into account productivity of workers, productivity has actually fallen in the last year or so. And what that means is your employment cost is actually going up even more. So let's just remember that. Your employment cost, you're facing a lot of pressure on employment costs on average. Now, here's the killer. So you guys are getting hurt because productivity's down and wages are up. But what about the people who work for you? Well, here I've got employed, full-time, or non-farm business sector, doesn't really matter much. What's happening to real wages, by which I mean wages minus inflation? The things that people really care about, right? In the end, you don't buy stuff with nominal money, right? You all know the price of goods is way up. And that means that workers, on average, are making less money. So they're making less money, but you're paying a lot more money. Okay, that wedge being productivity. That's very important to remember, that the reason the nominal wages are going up, but real wages are going down. And that's why real people are unhappy. So what's the skunk in the party? Well, the skunk in the party is inflation, as people have told you. And there's different measures of inflation. So for example, what I've got here is just the regular CPI, which we've already discussed. That's way up, and you can notice, you go back to 1988, you know, it's obviously very, very high. Personal consumption expenditures, that's something that the Fed looks at, okay? So that excludes a variety of things. It just looks at what you're doing, and that's very high. And then you exclude food and energy, and that's also a bit lower. But by any stretch of the imagination, inflation is unacceptably high. From the Fed's perspective, their target is roughly 2%. They don't expect to achieve that on a month-by-month or quarter-by-quarter basis. but you don't want to be the Fed guy that went down the way Paul Volcker's predecessor is viewed by history. Okay, that's not, you don't want that on your job resume. Okay, this can't go on, both for the Fed's perspective, from the public's perspective, from real wage perspective. We just can't let that go on. Okay, so what's driving inflation? Right, it's $1 million question. So I have a little bit of a two-person thing here. At the beginning, we had Team Transitory. And these guys were arguing, they emphasized transitory supply side issues, which you all know about. And they said, well, you know, it's this and it's that and it's this and it's that, all the stuff coming out of COVID, you know, shipping costs, et cetera, computer disks, et cetera. So, you know, that's identified with Paul Krugman. And so they were telling the Fed, don't do anything. It's all going to be better. Just relax. And they were wrong. Team Transitory was persistently wrong. Okay? Team Persistent, who identified with Larry Summers, he emphasized the demand pressures on the economy coming from fiscal and monetary policy, as I've just argued, was extremely accommodative during the peak COVID episodes. Okay? It's not a criticism to say that they were accommodative during the crisis. You know, it's the fog of war, right? We had to do something. But the Fed was behind the curve in raising interest rates, according to Larry Summers, and I personally agree with that. Certainly in 2021, if you go back, by the mid-year, we might have known that inflation was starting to go up a lot. What's the nightmare scenario that everybody worries about? It's a wage price spiral. Once people start to think that inflation is really persistent, that's when your labor folks come to you and go, look, my real wages are falling. This can't go on. 5% is not enough. 6% is not enough. At least keep me even with inflation. Well, then what do you guys do? To the extent that you agree to that, then you have to raise your prices, and we get this self-fulfilling spiral that gets extraordinarily hard and costly from a social perspective to stop. And then that is exactly what happened in the 70s. Until Paul Volcker came in and we had an extraordinarily painful recession, which none of us wants to go through again. So you got to nip this thing in the bud, is the conventional wisdom, before those expectations start to become self-fulfilling. So there's a big debate here now about, well, how much is it demand and how much is it supply? There's a really cool study in the San Francisco Fed where they basically looked at every product in the CPI and said, well, gee, if prices and quantities are moving in the same direction, there must be demand. And if prices are going up and quantities going down, it must be supply. So let's count every single good that we can get our hands on, and that way decompose things into demand and supply. And you know, this is for headline PCE inflation. This is for core PCE inflation that takes out the energy and food. And what you can see here is in the beginning, Team Transitory was not crazy. There were a lot of supply side shocks. So the orange is relatively important compared to the blue. As we move through time, notice over here, the blue is getting more and more and more important. So it's becoming a demand side driven phenomenon, which is a very difficult thing to stop. It's not going to go away by itself. This is what you worry about that becomes a wage price spiral. So, as was mentioned, inflation did peak, or it appeared to peak. Let's see what happens next month. You know, but in November 10, the Labor Department said the CPI, you know, had gone up by 7.7% on a 12-month basis. And, you know, compare that to June 9.1%. So that's good, right? That's a little bit of progress. Core CPI, a similar story. But in any event, remember, an improvement does not mean that you're where you need to be. Moreover, the market last Thursday, I'm sure everybody was in a very good mood, went crazy, okay? But if you look at bond yields, right, interest rates actually went down, which is exactly the opposite of what the Fed wants, right? So it's really critical for the Fed to, right, how are they going to slow down the economy? They're raising rates. You guys, if you see the slightest bit of not you guys, but if the market overreacts and interest rates go down in the long end, that makes their job that much harder. and that makes it less likely that they're actually going to ease, right? So again, we don't know what's going to happen. Now, the Fed, as proof of concept, the Fed is committed to fighting inflation. This is important. They're tapering. That is to say, they're not renewing their purchases of securities or treasuries, which is an important effect in the bond market. And they've also said, we're going to sell mortgage-backed securities if they don't run off fast enough. It's a little bit hard to predict those MBSs because of refinancing rates, things like that. And they said, look, we will sell things off outright rather than let them just run out. You all know that we're raising the federal funds rate, and the magical question is, how high should they and how high will they? So I have to be a little bit technical just for one moment to make a crucial distinction. Most of us think about the nominal interest rate. What's the nominal interest rate? That's I. You can ignore the notation if it bothers you. It's just your normal interest rate that you get on a bond. But what's the real interest rate? Well, the real interest rate is the nominal interest rate minus inflation. It could be expected inflation or it could be actual inflation. What does the Fed think affects real economic activity and ultimately inflation? It's not the nominal interest rate, it's the real interest rate. If you're, quote, rational, your cost of capital is after you take inflation into account. So the Fed has to get the real to a number that slows things down enough. Now, so they've got to work really hard to raise that expected real interest rate. But let me put what are these crazy dots? These are the famous Fed dot plots where they, each regional president says, this is what I think interest rates are going to be at each point in time going out into the future. So every dot there is a person. It could be Charlie Evans at the Chicago Fed, it could be Jim Bullard at St. Louis, Laura Bester, anyway, so each of those are his dots. And what you want to see is, typically you see medians, or they might give you averages, but notice there's a bunch of disagreement. The medians are going up, but there's some people there who think, they really think it's going to be pretty high. But on average, they think it's going to peak around 5% now. That's gone up a lot over time. If I showed you the dot plots 3 or 4 years ago, they really got it wrong. It wasn't just the private sector that got it wrong, it was the Fed also got it wrong. But they think they're going to peak at about 5 percentage points. This is, and they think we're going to have a soft landing. So what's this? This is from the September Federal Open Market Committee. This is their projections of what real GDP is going to be and the unemployment rate. That's the stuff over here. And you see there's some standard deviation there. So just look at the central measure. But it looks like they think, real GDP is going to decline, but it's going to be, quote, a soft landing. Maybe it'll be plus 1% or minus 1%, but it's not going to be anything like 2008. And the unemployment rate, they think, will peak at most, hardly any big increase, maybe at 4.5, which hardly seems like a lot. And it's the kind of some average of what the unemployment rate has been in the past. That's what I mean by a soft landing. So let's do some number experiments, because I want to set up a race. Suppose the short-term interest rate rose to 5%. That's what they're predicting, right? And say inflation actually stayed at 7%. Then the real interest rate would still be negative. They'd be paying you, right, to take out loans. That's a good deal, right? So the cost of capital is negative. That's hardly a prescription for a slowdown. But the question is, as they raise those rates, inflation is going to be coming down. So maybe I shouldn't keep inflation at 7% in my head when I do that experiment. We're going to see that there's this race. So there's a bunch of market participants who actually think that the federal funds rate will exceed 6%. It's not the average, but there's a bunch of people who think that. And if inflation then fell to 4%, okay, then we'd have a real rate of 2%, and that seems like kind of a rate that would slow things down. Now, why is this so darn... Now, let me just say, if you actually look at uncertainty of market participants, let's just get to that. So we have a race. I'll come back to that. It's a race. The race is the Fed's raising rates, inflation's coming down. The Fed knows exactly how quickly it can raise rates. It doesn't kind of know how fast inflation's coming down. So we're all betting on the race, right? So the Fed is looking real time to see if there's a persistent decline in inflation, how fast it is. So we have a data dependent rise in rates. Maybe it'll go down 50 basis points and they'll see what's going on with inflation. Maybe that will result in enough that they stop at 5, and maybe it won't, and they'll go to 6. Does the market think the Fed will succeed in lowering the inflation rate? Yeah, absolutely. If you look at standard measures, financial markets seem quite optimistic. If you just look at real interest rates, say from TIPS or something, and longer term inflation seems to be anchored. I will say this, that if you look at households, it's a very different picture. So this is inflation expectations backed out from financial markets, and you can see they're pretty reasonable. They've come down from what they were over here, but they came down because the Fed was raising rates. So financial markets said, yeah, we kind of believe you. If at the same time you had looked at households, which I'm not going to have here, they're less optimistic. So if you look at them going out a year, they think it's going to be 5%. But if you, even the households think that over the long run, we're to be about 2% or something like that. So the Fed has not lost credibility by that measure. Not to make this a seminar, but a lot of times we look at the average level. We don't look at how much people disagree with each other. And skewness is one statistical measure. There's a big fat right tail. That means there's a bunch of people who think that things are going to get out of hand. Okay, that's all you need to know about skewness, right? You can have two distributions have the same mean, but very different skewness. And that turns out to be a really interesting phenomenon. Skewness amongst households has started to rise a lot. That is, if you look at the Michigan survey of inflationary expectations, starting in the mid-half of 2021, skewness started rising. As skewness started rising, standard deviation goes up, right? Volatility goes up, or variance goes up. And eventually, everything shifts so much to the right that the average that we tend to look at also goes up. So there are people like Ricardo Reich who say, well, if you want a better measure of what's going to happen, look at skewness now, because that tells you what's going to happen to means in the future. So you look for a lot of disagreement now. If you see a lot of disagreement growing, that tells you that in the future, the average is going to go up. And interestingly, that's exactly what happened in, that's exactly what happened that happened in previous episodes like Volcker and before. This pattern of skewness going up, then translating to the median. Now, the Fed knows this. The Fed knows this. So they're looking at that skewness, right? And they're saying, we have to be concerned about this. We can't let that wage price spiral cost. We think 5% is what we have to do, but trust me, they know they may have to go higher. And we should know that too. Doesn't mean they will. Doesn't mean they will, but they might. Okay. So forecasts, they've been coming down. As you all know, every week we pick up the paper and it seems like forecasts are coming down. The IMF, just a couple days ago, now projects, the IMF projects the US real GDP growth to be 1.6 and 1% respectively in 2022 and 23. So they're not saying you're going to, quote, have a recession, but they're saying you're going to have very slow growth. And that's consistent with, you know, as I understand the view here and my own view that it'll be, you know, soft. If any recession, it'll be soft. But that is a pretty pessimistic view, that increasing pessimism. If you look at the National Association of Business Economists, more than 50% of the panelists think that there's a more than even likelihood that we're going to enter into a recession in the next year. Okay? And on November the 13th, the IMF cut its global growth forecast to 2.7% from a previous forecast of 2.9%. Where they think things are particularly weak, Europe is a basket case, China is slowing down, that's going to drag everything down and to some extent affect the United States as well. But that's, you know, that is not by any means the financial crisis. So if we look here, this is the probability that the US is in a recession in the next 12 months. This is from the Wall Street Journal survey of economists, and you can see that that's gone up substantially and is now about 60%. Another way to see that things have been, people are getting more and more pessimistic, here's GDP expectations. These are forecasts of economists, April 22, June 22, July 22, August, and you just see things are going down, down, down. But again, to remind you, this is very low growth. It is not the financial crisis. Okay, let me end with just one or two flash points and then take questions. Liquidity is, for real market participants know it's a very big deal. And one of the big problems that we've seen in the last couple of years is the treasury market of all things is less liquid than it used to be. Part of the problem there is that, and I won't take you through the weeds here, but if you are at a bank, because of regulations, it is much more difficult to be a market maker to hold those kind of assets on your balance sheet. It hurts your capital ratios. So banks don't want to do it, or they're less willing to do it. That means the market is kind of thin, right? And sometimes for reasons that we don't entirely understand, there's enormous amount of volatility in those yields. Now, here's just an example of where we are with liquidity. Bid-ask spreads have widened significantly over time. Market depth has declined sharply, and liquidity premiums have gone up in a variety of markets, but also in treasuries. So that's something we worry about. What could cause all of this to really be an enormous problem? So again, this is in the category of things that could happen, that should frighten you, but they're not my point estimate. The debt limit, this is coming upon us. The federal debt ceiling was raised in December of 2021 to 31.38 trillion. Now, the debt limit is a really weird thing. Congress votes on taxes, it votes on spending, so it knows what the deficit's going to be. The debt limit is another calculation that says, well, you said 1 and 1 is going to be 2, but we're only going to let you go to 1.5. It's this artificial limit on the total debt that we can have, even after they've decided to do their spending and their taxes. So what if Congress doesn't agree to increase the debt limit? Today, the Wall Street Journal reported that the Biden people had hoped to get a lame duck increase in the debt limit before the new Congress, and they've now abandoned that effort. It's just not going to happen. So it's going to be the new Congress that decides on whether we raise the debt limit. What was the last time we had a debt limit crisis? Well, it was around roughly 2011 when the economy was going along pretty nicely. And then we had that debt limit crisis, if you recall, and that put everything slow. It was a problem, right? We had a big slowdown in growth because of that. Even the threat of a default on treasuries, because at some point you can't pay because you're not allowed to. So then you can't pay treasuries. If that even was a threat to happen, that means yields would go crazy. But that means, and of course treasuries are the one safe asset, we think. They're the foundation of the financial system. If that was no longer true, all hell breaks loose. Now, no one has any idea what would really happen in that event, but Moody said, well, this would be kind of like the Great Recession, like the financial crisis. But again, I'm not saying that's going to happen. It's in the category of what's the tail event that I see that could really make me wrong, could make economists wrong, could make our point forecast here that we're talking about. That's the one thing. I mean, nuclear war, of course, but this is a financial thing that is not that crazy. It's not out of the realm of imagination that we would get to the point where we were in 2011, where we didn't actually default, but markets moved a lot because we thought that it was a possibility. So, now that I've ruined your lunch, I think that the Fed thinks we're heading for a soft landing with nominal interest rates peaking under 5%. My own personal view is that rates will probably go higher, 5.5, something like that, maybe 6. And that means growth will be a little more anemic than your baseline forecast, but by no means is that a crisis? And the one thing that could go really wrong for political reasons, not for economic reasons, right? This is a political scenario, and you might agree, you might disagree that they should or wouldn't. I don't want to be political, but if that happens, that will be a really major tail event that will be very harmful to all of us. So I'll stop with that.
Okay, we're going to turn to the Q&A portion. And of course, Marty, my first question has to be a follow-up. I'll just point out that the last time we almost came to default, it was because of the Republicans in Congress. And we all know, and as you know, Altair is independent. We don't take sides. We just like to point things out. How did that work out for the Republicans in the subsequent election? It didn't work out too well. So that at least I think gives us a bit of comfort that whatever grandstanding may happen, because I do think that cooler heads do recognize this danger, but I think it's important to point that out. So my first question is, and maybe we'll exclude this crisis. It's clear from your comments that you believe that a recession is a foregone conclusion. We think it's probably going to be more mild. You think it may be not a little bit more than mild. But I guess my question is, do you see any systemic risks other than this liquidity one, similar to what happened in the great financial crisis?
No, and the answer is no, and that's the good news. I think the banks are very well regulated. I know that their capital position is very good. Housing, we don't have a lot of leverage stuff like housing. So I don't think it's 2008. That's certainly not my point estimate. We know household debt structure is very good. Worry sometimes about, when you regulate the banks, capital moves away from the banks to less regulated areas. So you never say never because of the shadow banks. But there's nothing that I've seen that tells me that the shadow banks are systemically a problem. Although I do think as we move to high interest rates, some business models that made sense when cost of capital was very low no longer make sense, but that's not necessarily a systemic crisis.
Glad to hear that. Let's switch and let's talk about the US dollar. We've really seen an unprecedented rise in the dollar over the years. It certainly impacted multinational companies. It's hurt returns on foreign equities. Lately, it's weakened a bit. What do you expect the dollar's path to be going forward?
So, when it comes to forecasting exchange rates, first and foremost, I have no clue. So if you ask, can you beat a random walk when it comes to forecasting exchange rates up to horizons of a year? The answer is no. Nobody can do it. I hope we're not trying to do it. It can't be done. Okay? I mean, maybe somebody will figure it out, but So if you ask me, what do I think the dollar will be in 5 months from now? It's whatever it is now. It is also true that over longer horizons, we do have ways to predict the exchange rate. And over horizons of 5 to 10 years, I think you'll see a depreciation of the dollar. But that's not something you can bet on in terms of a short-term bet.
So what's extraordinary to me is that at least what we all learned in school and in postgraduate work was that over time the differential evens out in exchange rates, and certainly that has not been the case in the last 5 or 10 years.
Look, the carry trade is this. So Sergio Rebello, who's spoken here in the past, we wrote 10 years ago extraordinary profitability of the carry trade, which is basically borrow interest rates in a country where they're high and sell them, and borrow in places where interest rates are low and invest in where interest rates are high. That's a winning strategy on average because exchange rates don't do what they're supposed to in the text, like in the textbooks, because if you expect exchange rates to be the same, that means you expect your return on investing in high interest rate yields to be a good investment, right? Now, things Now, that carry trade is at the core of a lot of company strategies, say at Goldman or at big banks, et cetera. They make a lot of money on the carry trade. They haven't made a lot of money on the carry trade recently because interest rates were all so low, there was no differential to exploit. Now that interest rates are rising again, and not at the same rate, the carry trade's back in fashion.
Let's stay on the international theme. How concerned should we be about the economic outlook outside the United States, specifically in Europe, slowing growth in China?
So, basically, I agree with the IMF that even leaving aside tail events, the UK is in terrible shape, Germany is in terrible shape. There's just not going to be much growth in Europe over the next year. And so if you're exposed to Europe, you're just, it's not going to work out well. China is more difficult to predict, but they've certainly seen a slowdown. And they actually do have some systemic risk with their real estate sector, et cetera. But, China is different. They don't have to do things by interest rates, right? They could just send in the army and say, guess what? It's good. It's my way or the highway. So they have something even more powerful than the Fed, but it doesn't mean it's going to end well.
Let me ask Anna, do we have any questions from the audience? Not yet. Wow, that's surprising. How about our in-house questions? Do we have? We'll get you a microphone over here, and then we'll come to the back next. And Sam's coming over with a microphone.
Based on the scenario that you think is most likely right now, where do you see unemployment going in that scenario?
Unemployment?
Repeat the.
Oh, where do I see in my base scenario unemployment is going to? I think the Fed thinks it's going to peak at about 4.5. If I'm a little more pessimistic, maybe 5. But even that is, hardly a catastrophe. You have to be a little bit careful. I have to be a little bit careful. That's premised on assumptions about labor force participation rates. And if more people enter the labor force than we anticipated, the unemployment will be a little higher. If less people enter the labor force, because literally the unemployment rate is the number of people actively looking for a job who can't get a job. So if you have more people looking for a job, that is going to be an issue. Anyways, but I would say 4.5, 5, hardly a catastrophe.
And when I was going to school, 4% was considered full employment.
Yeah, I mean, and that sometimes that's controversial, but we expect there to be a normal churn, right? As people look for jobs, people leave the labor force for life reasons, having kids, et cetera. So we expect 4% to be sort of an average that's neither inflationary nor deflationary. And that's consistent. If you think the Fed thinks it's going to be 4.5, they don't know exactly, but they think that's roughly consistent with getting back to target and getting back to, quote, normal times.
And again, we're at 3.7%.
We're at 3.7, so that says you're going to have a recession, but not anything like the financial crisis.
In the back.
How long do you think it'll take before we'll see some real direction in rates, where it'll become much clearer where we're going to be?
Well, let me channel. How long do I think it will be before we see clear direction on these rates? Look, I think the Fed is trying very hard to convey that rates are going to continue to go up. So we were at 75 basis points going up. Assuming last Thursday didn't change their minds, they may punish us. But assuming they're not going to punish us, I think they're going to do 50, and they're going to look, because they don't have a crystal ball. So I think it's really much like this race analogy I was trying to give you, where they're seeing the outcome of the race while they're in the middle of the race, and they'll decide whether to go faster, longer, depending on how inflation responds. So, I think we're talking about a year-long episode, roughly speaking. I should say that when we back out uncertainty of market participants of where they think interest rates are from options, it's very high. It's a little lower than it was at the peak about a year ago, but if you look at options data and back out what uncertainty is in the mind of people betting on Treasury futures, that uncertainty is at a very high level. So like you and like me, most market participants, they have their mean expectations, which is what we focus on, but there's a bunch of disagreement there.
Question, or I think one more in the back, and then we'll come up front here.
Mine is, so if the wisdom was 4.6 and then now it's moved to 5 based on things that happened, you're suggesting 5.5, perhaps 6. What would your estimate be on how long they have to sustain it at that level before they would start to reduce?
Well, again, that's an issue of the response of how long would they have to keep it at 5.5 or 6 before inflation starts coming down? I don't think very long. I mean, 6 is, you know, if inflation at that point is say 4, then the real rate would be 2. That's a pretty reasonable cost of capital by historical standards. You know, so maybe they might stay there a quarter of a year, something like that. But I could be wrong. You know, I could be wrong. Could be a half a year.
So one of the things to focus on, and we've talked about this a lot in our investment committee discussions with Jason and David. I understand we're sitting here, and for many of you who are of the younger generations, you haven't yet experienced these types of markets, you haven't seen inflation. Marty and I and several other members probably of our studio audience and the audience at home remember the 70s. We remember gas lines. By the way, there was a war in the 70s too. There were certainly all kinds of geographic unsettling things. The Fed in the 80s under Paul Volcker did have to raise rates to 20%. Now, the Dow Jones was at 1,000 in the early 80s. And what happened with the right combination of monetary and fiscal policy is we saw one of the greatest bull markets in history from 1982 all the way to March of 2000. So I think, and again, we're not saying that it's not going to be a volatile time for the next 3, 6, 9, 12 months, but where we're going to come out is with normalized real interest rates. So if inflation gets down to 3 or 2, and by the way, we lived with 3% inflation a long time, we can sustain growth, we can sustain a healthy stock market. And by the way, this is kind of ironic, but the expected return now is based on real interest rates. So guess what? The long-term return for stocks is 10%, but that's when inflation might have been 3 or 4%, and we have a factor for risk. So actually expected returns are going up. Same thing with what Kara said about bond yields. Gee, we actually have real interest rate returns now going forward. So I think the medium to long-term opportunities, you have to be a bit optimistic, assuming, now I'm going to lead you into my next question, and then I'll get to you, Richard, and that's to fiscal policy. You know, there was a lot of talk about from some folks on an extreme that we had modern monetary theory. It doesn't matter what Congress can spend whatever they want. Deficits don't matter. What do you think about modern monetary theory?
Well, okay, so
Is it dead?
Well, it was never alive. But if, you know, it is dead because it should be dead. It's, you know, whenever someone tells you that there's free candy and Santa Claus is coming next, you shouldn't believe it, right? And that's what they were basically telling us. You know, you got to pay the bills in the end. It's really that simple. You can pay the bills in a lot of ways. You can pay it with inflation. That's a bad way to pay it. You can pay it by defaulting. That's not a very good way. But if you're going to rule those out, then you're going to have to cut taxes, or you're going to have to you're going to have to increase taxes, or you're going to have to cut spending. And then the question is, are you doing that intelligently? One of the problems that we have right now that we didn't have time to talk about is if you look at the composition of government spending, break it into things called discretionary and non-discretionary. You can, you know, but it turns out over time, because of the aging of the population and Social Security and Medicare and Medicaid, more and more of the budget is going to non-discretionary spending and less to discretionary, the things that, you know, we typically say, oh, let's cut this, let's cut. It's getting to be small potatoes. So cutting spending on the non-discretionary items, now we're talking about your health bill, we're talking about your grandparents, things of that nature, and that's much harder to cut. And we've so far managed to avoid that bullet. But if you looked at that CBO, Congressional Budget Office projection, that bill will come due. I'm not, I don't think it's going to affect us in the next year or two or three, but that's something, younger people are going to have to grapple with. How do we deal with that? And by the way, the loop to the Fed is this. When you have a debt to GDP ratio of say 40%, people in Congress don't care when you raise interest rates. Right? It's not affecting, the debt servicing is not a big deal in terms of their pet projects. Once you get to debt to GDP of 100%, the debt servicing is a really big deal. You raise the interest rates by 2-3% or T-bills, long stuff, that's really affecting the deficit. And that means that the fiscal guys are looking at the monetary guys, and now we have a food fight. Because remember, the Fed is independent, but that could change in a second. So one of the great dangers of having very high debt to GDP ratios are political pressures on the Fed to not do what they're supposed to do. We're not seeing that with this administration, and that's great.
Go to Richard.
So in the examples that we're showing, it shows rates go up and inflation is tamed in exchange for a little bit of a recession.
Mm-hmm.
But can you help us understand what went wrong in the 70s, which was rates went up to try to tame inflation. The recession happened, but inflation wasn't tamed. I mean, so-called stagflation, and then help us understand why that's not one of your worries that in the things that could go wrong.
The question is, why did we have inflation going up and a terrible recession? Rates were going up, recession went down, and why is that qualitatively different now? So it's actually interesting you raise this. I interviewed Ben Bernanke as part of some symposium. We talked about exactly this question, and he said there were at least 2 or 3 things that went wrong in the 70s. One was political. The Fed was not independent. Richard Nixon called Arthur Burns into the office and spanked him and said, this is what you're going to do. No way you're raising rates before I'm going to run for president. Okay, so that's this exact notion of not having an independent Fed. And there seems to be much more commitment by large parts of society to that. The other thing is that ideas matter, according to Ben, and I agree, that Arthur Burns was convinced that, and you hear echoes of this, it's the unions, it's corporations, it's greed, there's nothing we can do. And so let's not do anything. I don't think people believe that right now. The other thing, which is a little bit, has to do with expectations, it's a little more subtle. Once people start to embed their expectation inflations are very high, you really have to kill the economy. So if the Fed has no credibility, you have to teach the market that they're credible. And the Fed had no credibility then. Hopefully, we have more credibility now. That's an idea thing. And that's hopefully why the Fed is moving so aggressively now to make up for lost time. So I would say a combination of politics, ideas, and institutions make today different than the 70s.
Well, the only thing I would add, again, you had the unprecedented, it's a quadrupling of energy prices, which brought things through. You had sort of the payback for what was called guns and butter strategies of the late 60s, the Vietnam War, the Great Society. I mean, Medicare came into the law in 1965. And at that time, the expectation was that the life expectancy was a little more than age 65. So think about that. So the costs got out of control. You also then, so part of it was the reckoning, but the other side of it was the economy was much less nimble, and we didn't have, we hear a lot of criticism about outsourcing and just-in-time inventory and lowest cost provider, but we didn't have the flexibility of manufacturing on a global basis. So we have a much more flexible economy. But it does lead me to a question that is, I've always wondered, and that is, how do we actually define a recession? Because again, when I was in school, it was, well, you have 2 consecutive quarters of negative GDP, and that's a recession. Not so anymore. And what better person to answer that question than a member of the National Bureau of Economic Research?
So without being pedantic in a lecture, we talk about the 3 Ds: depth, duration, and diffusion. Right? So GDP falls every night when we go to sleep. We don't call that a recession. Right? There's no duration. If one sector of the economy gets hit by an idiosyncratic shock, we don't call that a recession because that's a specific sector. It hasn't diffused. And of course, depth, is it a serious decline? And that's where the growth rate under 2%, under 0 is typically mentioned, but it's got to be all 3. And please bear in mind, if you wait until the Bureau declares a recession, you're roadkill. We're record keepers. We're umpires. We're not forecasters. That's not, in that capacity, that's not what they do.
You get to call balls and strikes after the game's over.
After the game, that's why it's easy not to make a mistake.
Anna, are we at our time? Okay, well, let me just first of all say thank you, Marty. We really appreciate it. Jason and David, thank you. And Anna, thanks for putting everything together. And thanks to all of you in our room and attending virtually. We really appreciate it, and it is great to see folks in person. But I do notice that we are in a different world now where it is very easy to attend remotely, and we're grateful that those of you outside Chicago have attended today. We do look forward to this program every year. We hope that you found today's event to be valuable. If you use valet parking, we do have a coupon for you on the way out. We'll send one to those of you virtually if you want to park sometime for free here. I and Marty and some of our colleagues will stick around. We'll be here if you have additional questions. And we hope you come to future Altair events. So have a great afternoon and best wishes. Happy, healthy Thanksgiving and holidays to everybody. And again, thanks for attending.